Remember this Venn diagram from the very beginning of the CDLP course? How about the divorcing seniors? They have their own unique considerations and needs that come into play. They may have more retirement concerns at stake, and often they face cash flow limitations. Their homes may be paid in full, and now they are in a position of equity buyout or selling and downsizing. Is a reverse mortgage a sound financial tool and option for divorcing seniors? Within each demographic, this overlap of family law, financial and tax planning, real property distribution, and mortgage planning can have its own unique circumstances that need to be addressed. Part of the divorce process is dividing marital assets. The market value of an investment isn't always the only consideration when making these decisions, because some assets may be more useful later in life than others. For example, there may be future benefits to the spouse retaining the marital home. Let's look at a few of those benefits. Property taxes can be a steadily rising expense for homeowners of any age. Senior property tax exemption. States often provide tax exemptions for senior citizens who have reached certain ages. Some areas may base eligibility on Social Security status. The details of the senior exemption vary by state, and there are often residency and income restrictions. Some statutes defer the taxes until the property is sold. For details, contact your local Department of Revenue. You'll have to read the fine print, but it's still worth looking into the tax laws in your area. Another type of exemption to look into is the homestead exemption. Taxpayers who use a home as a primary residence may qualify for a homestead exemption. Most states have homestead property tax exemptions that allow you to protect a certain amount of the value of your primary property from taxes. This can be structured to either allow you to exclude a flat amount for a percentage of the taxable value. You are eligible for a reverse mortgage beginning at age 62. A reverse mortgage offers a potential stream of income. We will discuss a reverse mortgage more in a minute. Owning a home can also be an avenue for potential rental income. Whether renting out a portion of the house or, in later years, a divorced senior may move in with their children, a retirement home, etc., renting out the entire house for income. One of the best investments in homeownership is equity. Having access to that equity, however, can sometimes be a challenge, especially if there are limited income sources for mortgage qualification requirements. A failed marriage can be as hard on your wallet as it is on your heart. The financial consequences of divorce can be devastating for some seniors. Rising living expenses later in life can derail retirement plans or make it impossible for spouses to keep the marital home on a single income. There may be serious concerns for divorcing seniors needing mortgage financing. Many have already retired and may be on a fixed income. When they split up, that income is theoretically split in half, making it hard to obtain mortgage financing in a market of rising interest rates and the price of housing. According to USA Today, retiring can be 30 to 50% more expensive for divorced seniors. Seniors who divorce will also have less time to pay off debt and recoup potential losses. Additionally, the earning potential for seniors is far less if they have already left the job market to retire, again making it more difficult to obtain mortgage financing. Internal Revenue Code Section 1041A permits divorcing or separating spouses to transfer property between themselves without immediately recognizing a gain or loss due to the transaction. However, the spouse who receives the property takes a carryover basis and does not receive a step-up in basis to the fair market value at the time the transfer is made. The often unforeseen tax trap here is that the spouse receiving the appreciated marital property will eventually have to pay tax on the built-in gain of each asset that is subsequently sold. So, for example, if the cost basis of the marital home is $200,000 and the current value of the house at transfer is $500,000, there is no step-up in basis, and when the home is sold, there may be a built-in gain of $300,000, producing an unexpected tax liability. So, obviously, there is a real need for financial and tax planning for divorcing seniors. There is no way to sugarcoat the ramifications of divorce for seniors. For starters, your wealth may drop by half, assuming you split everything equally. At the same time, your expenses may increase. separate residences, and two sets of bills for everything from utilities to insurance. Researchers found that the standard of living for women who divorce after 50 drops an average 45%, and for men by 21%. In addition, the home you had planned to retire in may have to be sold and the proceeds split. Often, one or both spouses will have an emotional attachment to the marital residence. In many cases, this is the home that the children have been raised in, and there are many memories that are part of the home. Removing the emotional attachment, the home is simply a marital asset, and if one of the spouses is going to keep the residence, then they may have to acquire their spouse's equity ownership in the residence. If there is a significant amount of equity in the property, or if the house is fully paid for, the spouse who wishes to keep the residence will often have to take on significant debt in order to acquire their spouse's equity share. That's where it is worth considering the options for obtaining a reverse mortgage as a possible solution for divorcing seniors.